Hi, my name is Ben Walker and I'm working with Promise Yourself to tell you guys a little bit about the stuff that we're just not taught at school. So taxes, finances, all of that we just don't learn. And today I'm talking about interest. Now simply put, interest is a payment that's made as a percentage of a sum of money. It can be 5%, 10%, 10% is quite high. But for example, if you have 5% interest and it's £100, that's going to end up being £105. Now that can be on money lent, or money you borrow, or money that you put into a savings account. Either way, it would still be interest whether you're getting money or paying money. Now there's two types of interest. There's simple interest and compound. Now simple interest is when they take the original sum of money and you only have interest on that original sum. So for example, say again, you have £100 in a savings account and it's simple interest. You'll only ever earn money on the £100. So if you have 5% interest on £100, and then the next year you'll have £105, but you'll still only earn the interest on the £100. So the year after it goes up to 110, 115. Now, of course, it works the same way. If you're borrowing money, you will only ever pay interest on the money that you borrow. Now, the other type of interest is compound interest. Now this is a little bit more complicated because compound interest is when you pay interest or get interest on whatever the balance is of that sum of money. So for example, say you start off with a saving account of £100 and you have 5% compound interest annually. At the end of that first year, you will have £105. Then at the end of the second year, you would have got interest on the £105, which would take you up to roughly £110.50. So that's how it works. And that's a really good way with savings to get money quicker than simple interest because you're always earning money on the extra money you get from your interest. Now, of course, with a loan or a mortgage, it works the same way. So let's say you borrow £50,000 to put down for a property, and you're paying 5% compounded interest. After the first year, that's going to be £52,500. Now at the end of the second year, you will be paying interest on the £52,500, which is just going to end up costing you more money. Now, compound interest is how most loans and mortgages are worked out nowadays. There are calculators all over the internet that can help you figure out how much it would cost you. So definitely go and give that a check if you're thinking about using compound or simple interest and which one would work best for you. So like I said, it's all about figuring out which one's best. Simple versus compound, there's no one clear answer. Now for savings, it does make sense to have compound interest because you're just going to be able to earn more money. But if you're borrowing money, then again, it's a little bit more complicated. It depends entirely on what you want from your loan. Now, if you're borrowing a loan, it's short term and you just want regular, easy payments that's very easy for you to calculate, simple interest may be the way for you to go. However, you'll always be paying the same amount and it could end up costing you more in the short term. Now with compound interest, you'll slowly be paying down that loan, which means that you'll be paying interest on whatever you have. So let's say you have a £100,000 loan, you pay off 10,000, and then you're paying interest on 90,000 instead of 100. So if it's a long-term loan, compound interest could be the best way. But again, it's all completely up to you. Dealer's choice. Do your research and find out really. Now, it's really important to remember that lenders and banks all set their own interest rates. Now, generally, they tend to follow the Bank of England base rate. But they do, of course, set their own. Now, in 2020, the Bank of England reduced their base rate to 0.1%. This led to loads and loads of lenders reducing their rates as well, and that made lending money more affordable, so more people could borrow, more people could get mortgages. But it had a knock-on effect as well, because that meant that banks also lowered their rates, and so interest on saving accounts also dropped, so you make less money from a saving account. So it's a fine balancing act. There is no right or wrong answer there. For more information on saving and borrowing money and interest rates, just read the guide. It'll tell you a lot more that you need to know. But always remember that borrowing money is a big, big responsibility. You need to make sure you can afford these repayments because that could have a massive knock-on effect to your future life. For example, if you do borrow a load of money and then can't pay it back, that's going to affect your credit score, and your credit score can determine whether or not lenders think you're a risky option to lend to. If you want to know more about your credit score, just read the guide and watch the video that'll be coming out shortly. So just make sure you're taking it all into consideration. Shop around for the best deal for you. If you need to, if you are borrowing money, get some financial advice, and that way they'll be able to tell, any financial advisor or expert will be able to help you out and tell you whether it's the right option for you. Now, of course, with saving, you don't have to worry as much. You're putting your money aside for a rainy day. But again, read the savings guide and watch the video that's going to be coming out, and that can tell you more to do with savings. It's just very important to make sure you're being smart with your money. Make your money do the work for you rather than the other way around. Hopefully you've enjoyed this video and learned a little bit of something as well. Feel free to have a scroll through all the other videos that are out there, read the guides, learn as much as you can, and I'll see you next time.